a 20-story office building in downtown San Francisco, built in 2015 for $250 million. State-of-the-art elevators, floor-to-ceiling windows, premium location. 3 years ago, it was 95% occupied. Tech companies fighting for space, bidding wars for leases. Today, 30% occupied. The lobby echoes. Entire floors sit dark and empty. The parking garage is a ghost town, and the owner just defaulted on a $180 million loan. The building didn't burn down. It didn't collapse. Nothing physically changed. But its value dropped 70% in 3 years. The bank that lent the money? They're now holding a loan that's worth more than the building itself. And this isn't one building. This is happening to thousands of office buildings across America right now, from New York to Los Angeles, from Chicago to Seattle. Downtown after downtown is turning into a wasteland of empty towers. $1.5 trillion in commercial real estate loans need to be refinanced by the end of 2025. That's not a forecast. That's what's on the books right now. Loans coming due. Banks that have to decide, extend and pretend, or face reality. And here's the nightmare. Most of these buildings can't be refinanced. Not at today's values. Not at today's interest rates. The math simply doesn't work anymore. Regional banks across America are sitting on a ticking time bomb. And when it explodes, 2008 will look like a dress rehearsal. The clock is ticking, and there's no way to defuse it. Let's start with the number that should make every banker in America wake up screaming. 10.4%. That's the delinquency rate on office building loans right now. 1 in 10 office loans is already in default. Not struggling, not behind a month, in default. The borrower stopped paying. The bank isn't getting money. For context, during the 2008 financial crisis, the delinquency rate on commercial mortgages peaked at 10.1%. We're already past that level. And we're not even in a recession yet. But wait, it gets worse. That 10.4% is just the official number. The loans that are formally classified as delinquent. The reality is far uglier. 44% of office building loans are underwater. 44%. That means nearly half of all office loans in America are for more money than the building is currently worth. The borrower has negative equity. If they tried to sell, they'd owe the bank money after the sale. Think about what that means. If you're a building owner with a loan coming due and your building is worth less than what you owe, you have exactly 2 options. Come up with millions in cash to pay down the loan, or walk away and hand the keys to the bank. Most will walk away. Because why wouldn't they? It's a business decision. Take the hit to your credit. Move on. Let the bank deal with an empty building in a dead market. And the banks? They're about to own thousands of office buildings they don't want, can't sell, and can't rent. Buildings hemorrhaging money on taxes, utilities, and maintenance. Buildings worth half of what the loan says they should be worth. This is how banking crises start. Not with a bang. With thousands of small defaults that snowball into a catastrophe. Now let's talk about who's really at risk here. Because this isn't evenly distributed. This is concentrated in one specific type of bank. The kind that most Americans depend on. Regional banks. Regional banks hold 28.7% of their assets in commercial real estate loans. Let that number sink in. Nearly 30% of everything they own is tied to commercial real estate. Office buildings, retail centres, hotels, warehouses. For comparison, the big banks, JP Morgan, Bank of America, Wells Fargo, they hold 6.5% in CRE loans, less than a quarter as much exposure. Why the difference? Because after 2008, the big banks were regulated to death. Stress tests, capital requirements, restrictions on what they could lend for. They had to diversify. They couldn't concentrate risk. But regional banks? They stayed under the regulatory thresholds. They kept making the same loans they'd always made. Real estate developers were their best customers. Big loans, good relationships, solid collateral. What could go wrong? Everything. Everything could go wrong. And it is. There are over 4,000 regional banks in America. Many of them have 30, 40, even 50% of their loan book in commercial real estate. One major market downturn and they're insolvent. Not struggling, insolvent. Liabilities exceed assets, game over. And we're not talking about theoretical risk anymore. We're talking about right now. Spring 2023, Silicon Valley Bank collapsed. 16 hours from Healthy Bank to FDIC seizure. Then Signature Bank, then First Republic. All of them regional banks. All of them had concentrated risks. The government stepped in. FDIC guarantees. Fed lending facilities. Hundreds of billions to stop the contagion. Everyone exhaled. Crisis averted, but those banks failed because of bond losses and deposit runs. The commercial real estate crisis hasn't even hit yet. That's still coming, and it's going to be bigger, much bigger. Let's talk about the mantra that's been keeping bankers sane for the past 3 years. Survive until 2025. You heard it everywhere in the industry. Conference rooms, earnings calls, banking conferences. The logic was simple. Interest rates spiked in 2022. Commercial real estate values crashed. But it's temporary, they said. By 2025, rates will come back down. The Fed will pivot. Workers will return to offices. Everything will normalize. We just need to survive until then. So banks extended loans, modified terms, anything to avoid foreclosing and realizing the loss. Extend and pretend. Kick the can down the road. Survive until 2025 and we'll be fine. Well, it's 2025 and nothing normalized. Interest rates are still at 5%. The Fed can't cut because inflation is sticky. Office occupancy is still at 60% of pre-pandemic levels. Workers aren't coming back. Companies are shedding office space, not adding it. Remote work isn't a trend, it's permanent. And now all those loans they extended, they're coming due. With no solution in sight. The can has hit the end of the road. There's nowhere left to kick it. Morgan Stanley just released a report that should be front-page news but somehow isn't. They're forecasting a 40% decline in office building values over the next 2 years. 40%. That's not a correction. That's a collapse. If you bought an office building for $100 million in 2019, it's worth $60 million today, and Morgan Stanley says it's going to $40 million by 2027. Who can survive that? Not the building owner, not the bank that lent the money, not the pension funds and insurance companies that bought securities backed by these loans. Nobody survives a 40% wipeout, and it's not just Morgan Stanley. Everywhere you look, the warnings are piling up. The IMF, the Bank for International Settlements, the Fed's own financial stability report. They're all saying the same thing. Commercial real estate is a systemic risk. The losses are going to be enormous. And the banking system isn't prepared. Let's get specific about what happened to office buildings, because this isn't complicated. It's simple supply and demand. And the demand disappeared. March 2020. Pandemic hits. Everyone goes home. Work from home is supposed to be temporary. 2 weeks to flatten the curve. Then a month. Then 2 months. Then suddenly it's 2021 and nobody's coming back. Companies realize something. We don't need all this office space. People are just as productive at home. Maybe more productive. Why are we paying millions in rent for buildings that sit empty? So they start shedding space, letting leases expire, subletting floors, downsizing. A company that had 10 floors in 2019 renews for 6 floors in 2023, then drops to 4 in 2024, then moves to a cheaper building in 2025. And it's not just one company, it's everyone. Tech companies, financial services, law firms, consulting firms. The entire white-collar economy realized office space is a luxury, not a necessity. Look at the data. Office occupancy in major cities is at 60%. That means 40% of office space is empty. Not occasionally empty. Empty every single day. Dead space generating zero revenue. But the costs don't go away. Property taxes, utilities, maintenance, security, insurance. All of it still has to be paid. And if you're only collecting rent on 60% of your building, the math breaks down fast. Building owners tried everything. They offered free rent. They upgraded lobbies. They added gyms and cafeterias. They cut asking rents by 30–40%. Nothing worked, because companies don't want more space, they want less space. And the newer buildings? The Class A properties that were supposed to be immune? They're suffering too, because if you're downsizing, you move to the newest, nicest building and leave your old space behind. The vacancy cascades down. The older Class B and C buildings are now completely unmarketable. Zero demand. Zero value. Here's where the numbers turn truly terrifying. $1 trillion in commercial real estate loans mature in 2025 alone. $1 trillion in 1 year. And remember, 44% of office loans are underwater. Let's do the math. If even half of those maturing loans are office buildings, that's $500 billion. And if 44% are underwater, that's $220 billion in loans that can't be refinanced without massive losses. $220 billion of losses, concentrated in regional banks that don't have the capital to absorb it. Banks that serve your community, hold your business accounts, finance local projects. What happens when a regional bank fails? The FDIC steps in. Insured deposits are protected up to $250,000. But uninsured deposits? Business accounts with millions? Those get frozen, sometimes for weeks. Sometimes they take a haircut. And it's not just deposits. Credit lines get pulled, loans get called, letters of credit vanish. Businesses that depend on that bank suddenly can't make payroll, can't pay suppliers, can't function. 1 bank failure is manageable. 10 bank failures is a crisis. 100 bank failures is a systemic collapse. And we're looking at potentially hundreds of regional banks with fatal CRE exposure. The FDIC fund has $120 billion. Sounds like a lot. Until you realize they might need to backstop trillions in deposits at failing banks. They'll run out of money fast. Then what? More bailouts? More money printing? More moral hazard? Let's talk about a scenario that keeps banking regulators up at night. The doom loop. It starts with one regional bank failure. Pick any city. Cleveland, Charlotte, Phoenix. Doesn't matter. A regional bank with heavy CRE exposure can't extend a major loan. The building owner defaults. The bank takes a huge loss. Depositors panic. Bank run. FDIC seizure. News spreads. People start looking at other regional banks in other cities. How much CRE exposure do they have? Are they next? Better safe than sorry. Pull your money out now. More banks face runs. More seizures. The FDIC is overwhelmed. They start doing bail-ins, where large depositors take losses to keep banks open. Panic intensifies. Everyone tries to move money to big banks. Regional banking system starts to collapse. Credit freezes. Small businesses can't get loans. Construction projects halt. Commercial real estate prices fall further. More loans go bad. More banks fail. The loop accelerates. And here's the nightmare scenario. The big banks can't absorb all the deposits. They don't want the risk. They start limiting new accounts. Suddenly, tens of millions of Americans have nowhere to bank. The payment system seizes up. The economy stops. Far-fetched? Maybe. But we came within hours of this in March 2023. Silicon Valley Bank failed on a Friday. By Sunday night, the Treasury Secretary was in emergency meetings. By Monday morning, they announced unlimited deposit guarantees. They blinked. Because the alternative was unthinkable. Next time, the crisis will be bigger. The FDIC fund will be smaller. The political will to bail out banks again might not exist. And then what? Now let's talk about second-order effects. Because commercial real estate doesn't exist in isolation. It's connected to everything. Cities rely on property taxes for 40 to 50% of their revenue. When office building values collapse, property tax revenue collapses. Cities can't afford police, can't afford firefighters, can't maintain roads, services get cut, crime goes up, the city deteriorates further, more businesses leave, more buildings empty, death spiral. Pension funds and insurance companies own billions in CMBS, commercial mortgage-backed securities, bonds backed by pools of CRE loans. When those loans default, those bonds become worthless. Pension funds take massive losses. Insurance companies become insolvent. Retirees lose benefits. Policyholders can't collect claims. Construction workers, property managers, security guards, cleaning crews, all the people whose jobs depend on commercial real estate. Millions of jobs. Gone. unemployment spikes, consumer spending falls, recession deepens, more defaults, more job losses, another doom loop, and the psychological effect. When downtown turns into a ghost town, when the skyline is half dark at night because the buildings are empty, people lose confidence. In the economy, in the future, in the system, consumer and business confidence collapses, and confidence is what holds a modern economy together. So what can be done? Are there any solutions? Any way to avoid the catastrophe? The optimistic case goes like this. Convert office buildings to residential. There's a housing shortage. Empty offices could become apartments. Problem solved. Except it's not that simple. Office buildings aren't designed for residential. Different plumbing, different HVAC, different layouts. Conversion costs are enormous, often more than building new. And even when conversion is possible, the economics don't work. Office buildings are in downtown locations where residential rents don't justify the conversion cost. You'd lose money on every unit. Some buildings will convert. The best ones, in the best locations, with the right layouts. Maybe 5% of empty office space. The other 95%? No solution. What about the government? Can they step in? They could. Massive subsidies for conversions. Tax incentives for downtown housing. Direct purchases of distressed properties, bailouts for banks, all possible, all expensive, all politically toxic. Remember, we just spent trillions on COVID relief, trillions on infrastructure, trillions on climate initiatives. The appetite for another multi-trillion-dollar bailout for commercial real estate doesn't exist. Not among voters, not among politicians. So the most likely scenario is a slow, grinding crisis. Not a single dramatic collapse, just steady deterioration, banks failing one by one, downtown areas slowly emptying, property values grinding lower, credit tightening, growth slowing, a decade of stagnation. Japan after their real estate bubble burst in 1990. That's the model. 30 years of zombie banks, zombie companies, zombie economy, never quite collapsing, never quite recovering, just limping forward, decade after decade. Is that America's future? Maybe. Unless we're lucky. Unless something changes. Unless workers suddenly decide they want to return to offices 5 days a week. Unless interest rates collapse. Unless commercial real estate magically becomes attractive again. Don't bet on it. So what should you do? How do you protect yourself? First, understand your bank's exposure. If you use a regional bank, look up their financial statements. How much CRE lending do they have? Above 20% of assets, you should be concerned. Above 30%, you should be moving money. Keep deposits under FDIC limits. $250,000 per account type per bank. Business checking with millions? Split it across multiple banks. Yes, it's annoying. Better than losing everything when your bank fails. Avoid CMBS bonds. Avoid REITs focused on office buildings. Avoid regional bank stocks. These are all going to get hammered. If you own them, sell. Take the loss now. It'll be smaller than the loss later. If you work in commercial real estate, start planning your exit. Property management, leasing, commercial brokerage. These fields are going to shrink dramatically. Develop new skills. Find adjacent industries. Don't wait until you're laid off. If you're a small business owner, line up alternative financing now. Don't rely on your regional bank being around in 2 years. They might not be. Get relationships with multiple lenders. Stockpile cash. Prepare for a credit crunch. And if you're thinking about buying commercial real estate, God help you, because you're about to catch a falling knife. Yes, prices will be cheap, but cheap for a reason, because the fundamentals are broken, and they're not coming back. Let me be clear about something. This isn't doom and gloom for the sake of clicks. This is reality. The data is public. The delinquencies are real. The maturing loans are real. The underwater properties are real. $1.5 trillion in loans that can't be refinanced. 10.4% delinquencies. 44% underwater. These aren't predictions. These are facts. Happening right now. The only question is how bad it gets. Slow deterioration or sudden collapse. Managed decline or chaotic crisis. Either way, commercial real estate is broken, regional banks are in trouble, and the ripple effects will touch everyone. You can ignore it. Pretend everything's fine. Hope it works out. That's what most people will do. That's what most people always do. Until the day their bank closes and their deposits are frozen and they're standing in line at the FDC wondering how they missed the warning signs. Or you can pay attention. Adjust your finances. Protect your assets. Position yourself for what's coming. Not with fear, not with panic, but with clear-eyed realism and intelligent preparation. The commercial real estate time bomb is ticking, $1.5 trillion of it, and the timer hits zero in less than a year. The question isn't whether it's going to explode. The question is whether you'll be standing too close when it does. Thanks for watching. If this video gave you information you won't hear anywhere else in mainstream media, smash that subscribe button. We're covering the real stories, the ones that actually matter to your financial future. Drop a comment, let me know what you think. Are regional banks doomed? Will the government step in? Or are we watching the next financial crisis unfold in real time? See you in the next one.